Welcome back to Forex Gurukul. Today we are going right back to the foundation because before you touch a chart, before you look at a single candle, you need to understand the room you're actually trading in. This lesson is about the Forex market itself, what it is, who is in it, why it moves, how big it actually is, and when it is open. Nothing here is a shortcut to profit. It is the ground floor. Everything else in this school gets built on. Let us start with the plain definition. Forex, short for foreign exchange, is simply the global marketplace where one country's currency is traded for another. When a business in the United States needs euros to pay a supplier in Germany, or a bank in Tokyo wants to hold dollars instead of yen, that swap happens here. Unlike the stock market, there is no single building, no central exchange floor where this happens. Instead, Forex lives as a network, banks, brokers, and trading desks all over the world, connected electronically, constantly quoting prices to each other. So when someone says they trade Forex, what they really mean is they are speculating on the changing relationship between two of these currencies, most commonly against the US dollar, since the dollar sits on one side of the majority of trades worldwide. Now, every trade in this market is quoted as an exchange rate, and this idea is simpler than it sounds. An exchange rate is just the price of one currency measured in another. Look at euro dollar, the pair we will watch live in a moment. The first currency listed is called the base. The second is the quote. If euro dollar is trading around 110, that means 1 euro costs $1.10. Notice the wording, it costs. A currency by itself has no fixed value. It only has meaning relative to something else. That is why exchange rates move constantly. They are a live comparison of economic strength, interest rates, and sentiment between two economies, never a value standing alone. So who is actually behind these price changes? At the top sit central banks like the Federal Reserve or the European Central Bank. They do not trade for profit. They move interest rates and intervene to manage inflation and their currency's strength. And when they speak, this whole market listens. Below them are the large commercial and investment banks. These are the market makers, quoting bid and ask prices to everyone else and handling enormous client flow. Then come corporations, an airline buying fuel overseas, or a manufacturer paying foreign suppliers. They trade Forex simply to run their business. This is called hedging, not speculation. Hedge funds and large institutional traders sit here too. They take directional bets on macro trends, interest rate differences, geopolitical shifts. And finally, individual retail traders, people like you and me, trading through a broker far smaller in size, but plugged into the exact same live price feed as everyone above us. Here's something that surprises new traders. If most of the volume in this market was corporations paying invoices or tourists exchanging money for a vacation, price would barely move. Real trade volume is actually a small slice of the pie. The overwhelming majority of daily turnover, most serious estimates put it well above 90%, comes from pure speculation, funds, banks, and traders positioning on where they believe price is heading next, with no underlying shipment of goods or airline ticket behind the trade at all. This matters to you directly because it means price can move sharply on sentiment, on technical levels, on rumor, with zero real economic transaction happening behind it. The chart reacts to expectation, not just to invoices being paid. Now let us talk about scale. Forex is the largest financial market in the world by a wide margin. Rough industry surveys put daily turnover somewhere around $7 to $8 trillion. And to put that in perspective, that dwarfs the combined daily volume of every stock exchange on earth, including the New York Stock Exchange. Inside that enormous number, the spot market, meaning currencies exchanged for near immediate delivery, makes up the largest single slice, with the remainder spread across forwards, swaps, and other instruments used mostly by institutions to hedge future exposure. Retail traders, the individual accounts like yours, represent a comparatively small percentage of that total volume, but that slice has grown steadily every year as more people trade from home through online brokers. One more structural fact before we get to a live chart. Forex never closes for the day the way a stock exchange does in the afternoon. Because trading desks operate around the planet, one financial center opens as another is winding down. The rotation generally runs Sydney into Tokyo, Tokyo handing off to London, and London overlapping into New York. before the cycle restarts. That gives you a market that is live 24 hours a day, 5 days a week. But do not confuse open with equally active. Each session has its own personality. The Tokyo session tends to be quieter and range bound. London brings a strong pickup in volume, and the London-New York overlap, roughly 8 to 11 in the morning Eastern time, is usually where you get the sharpest, most tradable moves because two of the largest financial centers are live at the same moment. Let us connect all of this to something you can actually trade. When a new session opens, especially London or New York, you will often see a strong wide range candle print almost immediately. We call this a momentum candle. Classify it out loud every time you see one. It is a simple pattern, a single candle, not a multi-bar formation, and it is a continuation type, meaning it tends to push further in the direction it already broke, bullish or bearish, depending on which way that candle closed. Here's the part that matters more than the shape itself, context. That exact same candle appearing at a random moment mid-Tokyo session with no clear level nearby is close to meaningless. The same candle breaking a clean high or low right at the session open near a level price has respected before is a completely different trade. The entry trigger is a break beyond that candle's high or low with a touch of confirmation. The stop goes just past the opposite end of the candle with a little wiggle room for the wick, and the target should be sized off a proper risk to reward ratio at minimum 1 to 2. Be honest with yourself. These candles fail plenty of times. Session opens are famous for quick stop hunts, and your stop loss is the only thing protecting your account when that happens. Now look at the live euro dollar chart in front of you. This is the real market we have been talking about this entire lesson. First, check the time and figure out which session is currently active. That context changes what you should even be looking for. If you are inside the London or New York window, start scanning the last few candles for that wide, decisive momentum candle we just described, and ask whether it is forming near a level the price has already reacted to, not just floating in open space. Pause the video right now, look at your own chart, mark where you think a reasonable entry, stop, and target would sit on the most recent session open candle you can find, then come back. The method never changes, even though the exact price will be different every single time you watch this. That is the whole point. You are training your eyes to hunt for this setup live, not memorizing a picture from a textbook. Before we recap, let us name the mistakes that quietly wreck new Forex accounts. Trading without knowing which session is active and then wondering why price barely moves or suddenly explodes. Taking a pattern purely on its shape, ignoring where it sits on the chart. We said it once already, and it is worth repeating. Context always outranks the pattern. Entering a trade with no predefined stop loss, hoping the market comes back, treating every headline as pure economic fact instead of remembering most of the volume behind that move is speculation, not real trade, and sizing positions too aggressively during high volatility overlaps where spreads and swings are naturally wider. Let us lock in today's lesson. Forex is the decentralized global market for exchanging one currency for another. The exchange rate is always a relative price, one currency measured against another, never standing alone. Central banks, big banks, corporations, hedge funds, and retail traders all share the same market for very different reasons. The vast majority of volume is speculation, not real trade or tourism. This is the largest financial market on earth, trading multiple trillions daily, dwarfing every stock exchange combined, and it runs 24 hours across Sydney, Tokyo, London, and New York, with the overlaps giving you the best liquidity. Master these fundamentals before you master any pattern, because the pattern is the last piece, not the first.